You might think money is printed, stored, and moved around like physical goods, but the truth is far more astonishing. Most of the money in our economy isn't printed at all. It's created with a few keystrokes, conjured into existence by banks and backed not by gold, but by trust. In this video, we'll uncover the hidden mechanics behind how money is truly made, who controls its creation, and why it affects everything from your debt to global inequality. This is a story of power, promise, and possibility, one that will change how you see the numbers in your bank account forever. And now, let's pull back the curtain and step into the hidden world where money is born, moves, and reshapes civilization. Have you ever stared at the numbers in your bank account and asked yourself, where does this money actually come from? The truth is, the majority of money we use today isn't printed by machines. It doesn't sit in safes, nor is it transported in armored trucks. It exists as digital digits on a screen, typed into being by a system that appears simple, yet conceals an immense financial mechanism beneath. We live in an era where money is created by electronic signals, not by ink or paper. Every single day, billions of new dollars are added to the global economy, not by printing, but by being generated digitally. This isn't magic. It's the natural consequence of a credit-based banking system, one where your account balance isn't backed by gold or even physical cash, but by a promise. A promise that you can access those funds anytime, simply because a bank says so. And that is both a marvel and a concern. When money is no longer tied to physical limits, its power and its risk grow exponentially. Because now, value is not defined by gold mines, but by market confidence, consumer behavior, and monetary policy. Digital money has become the invisible lifeblood of the modern economy. But that raises a critical question: who controls its flow, and for what purpose? Long before money existed, humans exchanged goods and services not through currency, but through trust. Imagine a farmer in need of a tool, but with no crops yet to trade. He promises the toolmaker food after harvest. The toolmaker agrees, not because of any legal contract, but because he trusts the farmer. That promise becomes the first currency, a belief in future value. At the heart of every transaction was trust, a simple yet powerful force that enabled society to function without coins, bills, or banks. As communities grew and exchanges became more frequent, people needed a better system. Bartering random goods wasn't scalable or efficient, so they began using universally valued items, things everyone needed, like salt, cattle, or grain. These weren't just goods, they were early forms of money. Each carried intrinsic value and was accepted widely. Crucially, these items required labor and time to produce, giving them real economic weight. They weren't just tokens, they represented effort, scarcity, and survival. Still, these primitive currencies were bulky and hard to transport. Carrying sacks of salt or herding cattle wasn't exactly ideal. Enter gold and silver. These metals were rare, durable, and could be divided easily. They didn't decay, were easy to store, and became universally trusted. From Asia to Europe, gold was gold. It needed no translation, no explanation. It became the first global symbol of value, an anchor of trust that transcended borders and culture. And from that point on, money began to detach from physical goods. People no longer needed the thing itself, just a symbol of its worth. Notes, promises, and eventually digital entries replaced tangible assets. But the core remained unchanged: belief. A belief that what you hold, paper, coin, or code, has value because everyone else agrees it does. In essence, modern money is no longer just about what you have, it's about what others believe it means. When you walk into a bank and get approved for a loan, something remarkable happens. New money is created on the spot. No vault is opened. No existing funds are transferred from one account to another. Instead, the bank simply types numbers into their system. Voila! The money exists. This is not an illusion. It's a fundamental process in modern banking. Money brought to life by keystrokes and promises. The system doesn't require gold or physical bills, just a borrower, a lender, and a leap of faith. Contrary to popular belief, banks aren't just places where money is stored. Your account balance isn't a pile of cash waiting for withdrawal. It's a digital IOU. A promise that the bank will honor your request when you need it. But when a bank issues a loan, it doesn't pull that cash from someone else's deposit. It simply creates the loan out of thin air, an entry in a ledger, backed by your obligation to repay it with interest. This is how new money is born. Through debt. From a single loan, money begins to ripple through the economy. You buy a car, the dealership pays its employees, the employees spend their wages. That money flows to grocery stores, landlords, service providers. A chain reaction begins, all from one transaction. Each step generates more productivity, more opportunity. The economy grows not because someone saved up coins, but because someone borrowed wisely. In this way, loans fuel the real economy, generating value from potential. Yet there's a catch. If everyone demanded their deposits in cash at once, banks would collapse. That's because the money they have is mostly digital, existing only as long as people believe in the system. This vulnerability, known as a bank run, has shaken nations. The system functions only if we trust that most people won't panic at the same time. It's a fragile but powerful consensus, and it underpins the entire financial architecture of the modern world. Banks are not just middlemen, they are modern-day alchemists. They turn promises into purchasing power. They convert needs into circulating value. When you understand this, you realize that money doesn't come from labor or minds alone. It comes from contracts, credibility, and creativity. In today's world, value is not merely extracted, it's synthesized. Debt isn't just a burden, it's the primary engine of monetary expansion. And the power to create money is one of the most profound forces shaping civilization today. When a bank creates money through a loan, that money doesn't sit still, it moves. A person takes out a loan to buy a car. The car dealership receives that money and pays its employees. Those employees use their wages to buy groceries, pay rent, or go to the doctor. Each transaction triggers another. What started as a digital entry in one account becomes a chain of productivity, fueling business, sustaining jobs, and circulating value throughout the economy. Money, when in motion, becomes the lifeblood of society's progress. Money by itself holds no power unless it's used. A stack of cash hidden in a vault contributes nothing. But when it's spent, invested, or loaned, it sets industries in motion. That's why modern economies don't thrive by hoarding. They grow through flow. Every exchange is more than just movement of capital. It's the conversion of money into value, effort into outcome. Like gasoline in an engine, money must be burned in productive cycles to generate momentum. Idle money is wasted potential. However, not all money flows are equal. When loans are used for speculation, buying properties to flip, hoarding assets, or chasing hype, they don't generate real goods or services. Instead, they inflate prices and widen inequality. This misdirection of credit leads to bubbles, instability, and artificial prosperity. For money to fulfill its true function, it must fuel the real economy, industries that create, build, and serve. It's not just about movement, it's about meaningful movement. We must understand, money is a tool, not the destination. When channeled purposefully, it enables innovation, empowers people, and lifts communities. When misused, it breeds fragility and distortion. Whether it becomes fuel or fire depends on intent and design. Every loan, every dollar circulating through society carries within it the seed of progress, or the spark of imbalance. What we do with money determines whether our economy grows stronger or collapses under its own illusions. When governments need money beyond their tax revenues, they don't simply print more, they issue bonds. These bonds are essentially IOUs, promises to repay borrowed money with interest. Who buys them? Banks, corporations, wealthy investors, and even foreign countries. In doing so, they lend real capital to the government in exchange for these promises. And with those funds, governments finance everything from infrastructure to healthcare, from military to welfare. But behind every new school or road built lies a debt contract signed with unseen hands. Once the government spends this borrowed money, it flows back into the economy through contractors, salaries, suppliers. These recipients spend their income creating jobs, goods, and more transactions. But there's a catch. To repay the bonds, governments rely on tax revenues, your money. What began as an economic boost eventually becomes a financial burden for citizens. The public often benefits in the short term but ends up footing the bill in the long run, often without realizing who the real lenders were. Debt isn't inherently bad, it can be a catalyst for progress when used wisely. If borrowed money builds universities, renewable energy systems, or public transit, it yields returns that outweigh the costs. But if it's used to cover bloated bureaucracies or short-term political promises, The result is wasteful debt with little lasting value. The issue is not borrowing, but borrowing without vision. Interest compounds, and soon, governments spend more servicing debt than investing in their people. That's when debt becomes a silent thief of opportunity. Worse still, when tax revenues fall short, governments issue more bonds to pay off old ones, borrowing from Peter to pay Paul. This debt spiral grows deeper with every cycle. Developed nations may weather the storm thanks to global trust, but emerging economies often face collapse when confidence vanishes. A society that blindly trusts its leaders to handle the money, without question becomes vulnerable to long-term decay, masked as temporary relief. The true creditors of a nation aren't always bankers or hedge funds. They're its people, and the generations that follow. Every bond is a promise written on the backs of tomorrow's taxpayers. That's why fiscal responsibility isn't just a financial matter, it's an ethical one. The power to borrow is the power to shape destinies. Whether we use that power to build a brighter future or to mortgage it depends on how well we understand the stakes. In the end, debt is not just numbers on a balance sheet, it's a mirror of our collective priorities. Inflation occurs when the amount of money in an economy grows faster than the goods and services available to buy. If more dollars chase the same number of products, prices inevitably rise. It's simple supply and demand, but with far-reaching consequences. Adding money to the system doesn't automatically create more value. Without matching productivity, each new dollar decreases the purchasing power of the one before. Inflation, in this sense, is a hidden tax that erodes your savings, reduces your income's real worth, and silently redistributes wealth. However, not all inflation is harmful. A modest, controlled inflation rate can actually boost economic momentum. When people expect prices to rise slightly, they tend to spend and invest sooner, which energizes businesses and job creation. That's why many central banks target a small inflation rate, typically around 2%. But once inflation spirals out of control, fueled by reckless spending or unchecked monetary creation, it undermines economic stability. When people lose faith in the currency, they stop spending, saving, or investing, and chaos follows. This is why central banks exist, to manage inflation through interest rates and monetary supply. In the past, banks could only lend a fraction of the cash they held in reserves. But now, with fractional reserve banking and digital money creation, they can generate nearly unlimited credit if they meet minimum liquidity requirements. And if reserves run low, they simply borrow from the central bank. This raises a disturbing question. Who, if anyone, is truly controlling the money spigot? If printing money is so easy, why can't governments eliminate poverty with a few keystrokes? The answer lies in confidence. Currency derives its power from collective belief. Once that belief cracks, when people think money will keep losing value, they abandon it. That's when hyperinflation begins, and history has shown how devastating that can be. The lesson is clear. The value of money isn't just about quantity, but credibility. Without trust, even trillions are worth nothing. What if banks created money not just to fuel consumption, but to build a better world? Imagine a system where new money flowed not into speculation or luxury, but into education, healthcare, clean energy, and groundbreaking research. Each dollar would be a seed, planted with purpose to grow long-term societal wealth. Instead of igniting short-term demand, this type of credit would expand productivity, reduce inequality, and foster true human progress. Ethical money creation isn't fantasy. It's a decision, a design, a direction. Today, most new money is funneled into real estate, stock markets, and consumer debt. These sectors can generate quick returns, but often produce little lasting value. The problem isn't just economic, it's moral. We've built a financial system that rewards short-term profit over collective well-being. But what if every dollar created had to answer a question? Whom does this serve? If our credit system prioritized social return over speculation, we could transform money from a tool of accumulation into an engine of empowerment. There are already glimpses of a better path. Ethical banks, community lenders, and decentralized finance, DeFi platforms, are challenging traditional norms. They focus on funding sustainable agriculture, small businesses, clean technology, and affordable housing. These institutions operate transparently, cut out harmful intermediaries, and give power back to local economies. Though small in scale today, their impact is growing, and their message is loud. We don't have to accept the status quo. We can reimagine how money flows. Money is more than a medium of exchange. It's a reflection of what we value as a society. If we create money for consumption and competition, we get inflation and inequality. But if we create it for creativity, community, and collective resilience, we build a civilization worth inheriting. Changing how money is created may be the most powerful act of redesigning the future. It requires bold policymakers, conscious bankers, and informed citizens. But it starts with asking the right question: is our money funding a world we're proud of? The final truth is this: money is not neutral. It shapes behavior, priorities, and outcomes. It is a silent architect of civilization. And because it is human-made, it can be human-remade. Just as we engineered money to serve trade, we can now engineer it to serve life. A financial system rooted in ethics, impact, and purpose isn't just possible, it's necessary. If we dare to dream, we can design a world where every dollar created becomes a force for good. We live within a system where money is no longer coins or paper. It's belief, power, and vision. Once you understand how money is truly created, not from printing presses, but from debt, trust, and digital code, you're no longer just a player in the economy. You become a conscious architect within it. The real question isn't how much money exists, but why does this money exist, and where is it flowing? If we want a more just, innovative, and resilient world, we must reimagine money's purpose. We must demand that money serve people, not the other way around. Because in the end, money doesn't just shape our economy, it shapes our destiny, and we have the power to shape money itself.